The most dangerous moment in any market is not the crash. It's the moment right before it when the price still looks under control, but the behavior underneath is no longer normal. When the market has to work harder to stay stable, when every rally feels forced, every dip gets bought in desperation, and the system starts showing you something subtle but unmistakable. It can't hold the line forever. That's the exact feeling building in silver right now. Silver is losing price control. And the reason this matters is simple: silver is one of those markets where control doesn't fade gradually. It holds, and then it snaps. And if you think that sounds dramatic, let's ground it immediately. This isn't about a conspiracy or a cartoonish they're manipulating its storyline. This is about structure. Silver is a small market compared to global capital. It is essential to the real economy. It's split between paper trading and physical reality. And when those layers stop moving in sync, price control becomes an illusion. The market can hold the line for a while through liquidity, hedging, and paper flows. But when physical demand stays firm and available supply tightens, at the margin, the system starts burning through its buffers. That's when control becomes expensive, and expensive control never lasts. Stay with me until the end, because the most important part of this story is not the chart, it's the sequence. The sequence that tells you whether silver is simply volatile, or whether it's entering a phase where price moves become discontinuous jumps. Gaps, violent repricing, because the market is no longer negotiating, it's reacting. Let's define losing price control in a serious way. It doesn't mean prices rise every day. It means the market's normal balancing mechanisms are weakening. In a healthy market, when prices rise too fast, supply appears. Sellers come in. Inventories are released. Buyers back off. Spreads tighten. The market breathes. In a stressed market, that breathing becomes shallow. Sellers become reluctant. Demand remains stubborn. Spreads widen. Premiums rise. The market begins behaving like it's tight even on days when the headline price pulls back. That is what price control loss looks like. The system no longer has a comfortable way to calm itself down. And the reason this shows up so clearly in silver is because silver lives in two realities at the same time. There's the paper market futures, contracts, ETFs, derivative exposure, synthetic trades. That layer is huge because it's easy. You can buy and sell billions in exposure without moving a single bar. And then there's the physical market, the silver that has to be refined, fabricated, shipped, insured, and delivered. The silver that manufacturers need, the silver that investors demand when they stop trusting paper. The silver that exists in certain forms, in certain locations, in certain delivery hubs, and not magically everywhere at once. When a market is calm, the paper market and the physical market stay linked. Arbitrage keeps them honest. If physical is tight, paper price tends to reflect it. If paper gets overextended, physical supply helps cap it. But when a market becomes stressed, those links weaken. Paper can trade as if silver is abundant because it's trading claims. Physical can tighten because it's trading reality. When that separation grows, the market loses price control. So what is driving the separation now? Three forces, all stacking at the same time. Structural industrial demand, slow and constrained supply, and shifting financial behavior as the macro environment becomes more unstable. Let's start with industrial demand, because this is the foundation. Most people underestimate silver isn't just a precious metal anymore. It's a critical conductor in the technologies that are being scaled aggressively. Solar panels rely on silver for conductivity and efficiency. EVs and modern vehicles use more silver because of electronics, sensors, and power systems. Data centers and advanced computing use silver through high-performance hardware and power management. Medical technology uses silver's antimicrobial properties. Defense systems rely on advanced electronics where performance matters. And here's the key. Much of this silver is consumed and dispersed. It doesn't come back easily. It gets embedded into products in tiny amounts that are not economical. To recycle at scale, that means demand is pulling silver out of circulation and not returning it to the market in a smooth way. That's not a normal commodity dynamic. That's a slow drain. Now look at supply. Silver supply is stubborn. New mines take years to develop, or grades decline, costs rise. Environmental and permitting constraints slow expansion. And much silver comes as a byproduct of other metal mining, which makes silver supply less responsive to silver prices alone. Even if prices rise, supply doesn't surge the way people assume. Supply can lag for years, which means the market relies on inventories to fill gaps. But inventories are the buffer, and buffers don't last forever. When buffers shrink, the market becomes sensitive. It becomes jumpy. It becomes a market where small changes in demand cause large moves in price. That's how you get a loss of control. Now add the financial layer. Investors are living in a world shaped by inflation memories, debt burdens, and geopolitical risk. Even when inflation cools, the fear of it returning remains. Even when markets rally, the sense that the system is fragile remains. In that environment, hard assets regain attention not as a hobby, but as insurance. Gold is the classic insurance, but silver is the volatile version. Cheaper, faster moving, more explosive in percentage terms, and more tied to industrial constraints. The dangerous moment is when investment demand and industrial demand overlap, because then you get a double pull real-world necessity plus financial hedging. That overlap doesn't need to be massive to matter. Silver is a small market. It only needs to tighten at the margin for price to become unstable, and that's where the phrase, "the market can't hold this line," becomes real. When a market is losing control, it starts producing tells. The tells are not always visible to casual observers, but they show up as behavior. One tell is that dips stop behaving. Normally, in a healthy market, a sharp move down draws in sellers and cools the market. In a stressed market, dips become shorter because buyers are more urgent. They aren't buying because they like the price. They're buying because they're worried about access later. Another tell is that premiums and spreads can remain stubborn. Even when paper prices pull back, the physical market doesn't fully relax. Availability feels tight. Delivery feels constrained. The real market doesn't fully follow the screen. Another tell is institutional behavior. When banks and large intermediaries sense tightening, they become cautious. They tighten collateral requirements. They become less willing to lease or lend metal. They hold inventory more tightly. They structure contracts differently. They do not announce this publicly. They just behave differently, and that behavior tightens the market further. Now, let's talk about why this matters for Americans specifically. Because it's easy to treat silver as a niche metal story. But silver is embedded in the real economy. If silver prices and procurement costs rise meaningfully, it can influence the cost structure of industries tied to energy, electronics, and infrastructure. It can contribute to inflation pressure in areas that don't look like silver in the consumer basket but are downstream of it. It can squeeze manufacturing margins. It can slow project timelines. And it can become a signal that supply chains are tightening again. It also matters because silver is a confidence gauge. When markets become uncertain about monetary stability, metals often reflect that uncertainty. Silver moving aggressively can signal that the market is pricing higher volatility ahead through inflation volatility, policy volatility, or economic stress. So, what happens next if the market truly can't hold the line? The first phase is the tug-of-war phase. You get repeated tests of key levels. The market looks like it's being held in range. People argue about technicals, but underneath, pressure builds. Demand continues. Supply doesn't respond. Inventories shrink. The second phase is the liquidity phase. A catalyst hits maybe. A macro print, maybe a policy signal, maybe a supply disruption, maybe a surge of investment demand. The market tries to adjust. If liquidity is thin, the adjustment is not smooth. It becomes gappy. Volatility spikes. Moves accelerate. The third phase is the repricing phase. This is where control breaks. The market moves into a new range, not because of speculation alone, but because the old price no longer clears the real market. The price must rise to reduce demand, attract supply, and restore balance. That is how commodity markets solve constraints, through price. And here is the part most people miss. Repricing is not just a number going up. Repricing changes behavior. It forces industrial buyers to lock in supply earlier. It forces investors to chase. It forces shorts to cover. It forces intermediaries to tighten even more. Repricing itself becomes a driver. That's why silver breakouts can look violent. But I want to be careful here, because equality analysis isn't about screaming to the moon. It's about understanding risk. Silver is volatile. It can swing hard in both directions. In broader market stress events, forced selling can temporarily knock silver down, even if the long-term thesis is bullish. That's why the most important thing is the sequence. If silver sells off with everything else briefly, but then rebounds faster and holds higher levels, that's a sign the underlying pressure is real. If silver rallies but physical tightness doesn't improve, that's another sign the market is strained. So what should viewers watch to know if silver is truly losing price control? Watch whether pullbacks are being bought, quickly and aggressively. Watch whether the market keeps returning to the highs after dips. Watch whether physical availability feels tight even on down days. Watch whether premiums and delivery conditions remain firm. Watch whether the conversation shifts from price to access. Because the moment a market shifts from price-focused to access-focused, the nature of the market changes. It becomes less about speculation and more about scarcity. And scarcity markets do not behave politely. If you're still here, here's the final idea, the one that makes panic mode make sense without sensationalism. Price control is not a conspiracy. Price control is a function of slack. Slack is inventories. Slack is sellers willing to sell. Slack is supply chain flexibility. Slack is demand that can back off when prices rise. When slack exists, markets stay orderly. When slack disappears, markets become jumpy. And when a strategic commodity like silver becomes jumpy, it's a sign that the system is tightening in ways that can spill into the real economy. So if the market can't hold this line, the move won't announce itself in advance. It will show up as a sudden expansion in range, rising volatility, and a new price zone that feels impossible to the people who assumed the old price was stable. That is what panic mode really is. Not fear, but a market being forced to admit something changed underneath. And in silver, once that admission happens, the next phase tends to be fast.